Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to see what's going on with Twitter. We'll take a look at that, and I'll give you my financial opinions around it. If you want to follow me, you can follow me at finding_finance. If you want to follow me on Twitter, and if you guys need any sort of help with this commodity bull market that's coming up, definitely hit up finding-value.com. You can see my portfolio, the companies that I've got in it. And we also have these platinum question and answer sessions that we do on the weekends if you guys have any questions or need any help with anything. So let's dive in, see what's going on. We've got Germany faces 1 trillion challenge to plug massive power gap. About 250 gigawatts of new electricity capacity needed by 2030. Germany needs 43 soccer fields of solar power every day to make that happen. So that's what's going on in Germany land. We've got global container freight rates, the 40-foot containers. And this guy is definitely falling off a cliff, and it's way, way down there. Now, I know other people look at this and say, oh man, it's down 82% from its peak. I look at it like, well, it's down 82% from its peak because it's probably something to start looking into to see if it's worth purchasing. You want to buy when things are low. I mean, obviously this has been going down. It's probably going to bounce and base for a little bit, but when things go down and they become cheap, that's when I start getting interested. It says, would you buy this chart, year-to-date chart? No, I wouldn't. You've got lots of downside pressure. If I were to guess what this is, I would take my guess and say it's silver. But that's my guess, and no, I would not buy at this particular second. It says rents rose in 58% of all counties nationwide between 2020 and 2023. How much did they increase in your neighborhood? Inflation adjusted percent change in one-bedroom fair market values. I think they went up quite a bit in Colorado Springs over here. He says, I think small cap oil and gas producer equities are the contrarian play here. Similar to Canadian oil a couple years ago, there are big followings for those mid-cap Canadian producers. And he's just looking at the SPY, XLE, WTI, and PSCE. Another way that you could view this is that the big boys move first, which is XLE, and then the other guys like PSCE and these small caps follow later. So it still means that we're early in this bull market, because generally the performance of the small caps start to outweigh the performance of the larger guys. And that hasn't happened according to this picture here. Even if you look at the rate of change here on these coming up, XLE is still a pretty good outperformer there. Looking at North American natural gas supply analytics, open this up. What this is your days of storage year-over-year delta. And this is your pricing, your 1 month forward pricing. So you can see where the star is at. You could generally say you're expensive above it, cheap below it. And we're slightly below it, so it's on the cheap end given where we are for days of storage. When we look at the weekly change in U.S. gas storage versus the 5-year average, the actual injections are the green, and the gray is the 5-year average injection withdrawal. And you can see that we've got a lot less in the green here for the weekly change in U.S. storage. And there's the average of what we see over this time frame. This is the days of storage relative to the 12-month U.S. demand plus U.S. net exports. And you can see that we're coming towards average. So that's the 5-year average. 2023 is the dark line. You can see 2022, we were on the low end. That entire time, we were hugging the low end of that 5-year average. So that's natural gas there. We've got, I wanted to go through this thread here. Money printing doesn't work like you think, and here's the thread on it. He says, without properly understanding money, it's basically impossible to connect the dots of the global macro puzzle. Yet we assume we know all about money. Universities teach us that governments need money to fund their spending. Central banks print the money we use. And banks lend and multiply customers' money in a fractional reserve banking system. That's literally all wrong. Our monetary system runs on two distinct tiers of money: real economy money, potentially inflationary, and financial sector money, potentially asset price inflationary. Governments and commercial banks print real economy money. Central banks print financial sector money. Let's precisely define the two forms of money. Real economy money is money used by us, non-financial private sector agents, households, corporates. With it, we make transactions that contribute to economic activity. The more real economy money out there, the more likely economic growth will be stronger. Also, a rapid increase in real economy money when the supply of goods and services can't keep up will most likely generate strong inflationary pressures. Financial sector money is money used by financial entities, mostly banks and also pension funds, asset managers, etc. Now, who prints what form of money and how does it work? Today, real economy money is mostly bank deposits held by a non-financial private sector. Read held by us. Cash represents the rest. Every time commercial banks make a loan, new real economy money is created. And that's what I talk about the business cycle. When commercial banks make a loan, new real economy money is created. The credit expands. So that happens in the commercial banking system and the consumers. New loans, new deposits, new loans, new deposits. And they just flip depending on who has those loans and deposits. It's an asset for the bank. It is a deposit for the consumer, depending on who loans it and who deposits it and who gets paid and who does the lending and all that stuff. It says, banks don't lend reserves or existing deposits, as the Bank of England itself shows. When making new loans, banks expand their balance sheet and literally credit your account out of nowhere. Did you notice how the amount of reserves is irrelevant in the lending process? Banks' lending activity depends on the creditworthiness of the borrowers, the attractiveness of loan yields, the required capital and balance sheet costs. More QE equals more financial sector money, not real economy money. Conclusion, banks print real economy money. The other real economy money printer is the government. Come again? Yes. If the government spends more than it plans to collect in taxes for deficits, in most cases, new real economy money has been created. Government deficit spending increases the net worth of the private sector without adding a liability to it. So think about it. When the US government sent checks to its citizens, American people literally saw the amount of their spendable money increase out of nowhere. And that's the deposits coming into the system. It says deficit spending increases the amount of non-financial private sector deposits, real economy money, as long as households don't need to purchase the treasuries issued by the government itself. This means deficit spending prints real economy money. I agree. And it increases the net worth of the private sector as households don't experience an increase in debt. In other words, government deficits boost the financial wealth of the private sector. In most cases, deficit spending equals real economy money printing. Agreed. And that's your annual change in financial assets. It's vice versa. So private sector is the green, the purple, government is the blue. It says, as shown, banks and the government print real economy money. Credit creation boosts aggregate demand, and it can lead to inflationary pressures. That's exactly what we've seen in 2020, 2021. Massive fiscal deficits and government-sponsored bank lending ending up overheating. The economy resulting in super strong real GDP growth and inflationary pressures on top. My TMC Global Credit Impulse tracks the pace of real economy money creation in inflation-adjusted terms in the 5 largest economies in the world. So this is the chart, Global Credit Impulse. Boom, 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 boom. This is also the S&P year-over-year earnings per share growth as it goes up with it. Now we've seen that come back down, and we're starting to see it go negative. And that takes about, I would say, about a year for that to hit, about 12 to 18 months to hit the numbers that people track, somewhere in that range. And we might come and have a slowdown this summer. says, as you can see, rapid changes in the amount of real economy money anticipate rapid changes in economic growth. So in most cases, government deficits and bank lending prints real economy money, not central banks. They print financial sector money. Via QE and other monopoly operations, central banks print bank reserves. You can't think of them as money for banks. Banks use reserves to settle transactions and engage in monetary plumbing operations with each other. Reserves can only be used by entities with a central bank account. With QE, the central bank changes the composition of the asset side of the financial institution's balance sheets. It takes away bonds and swaps them for reserves. Now, financial institutions have less bonds and more reserves, banks, or financial sector deposits. Central bank, commercial bank. So it says, as I said before, banks don't lend reserves to the real economy. You can throw as many as you want to them, and it won't change their stance when it comes to lending. Japan showed us that in the early 2000s already. Yeah, it's demographic driven. So what he's describing is the thesis that I've got is demographics drive the interaction of home lending and credit creation from the commercial banks interacting with a larger demographic, and those new loans is putting credit into what he considers to be the real economy money. And that's what's inflationary. And I agree with what he's saying. It says bank reserves red doubled in 5 years as the BOJ went on with QE. And yet bank loans blue shrank by 25% in the same period. With double the amount of reserves, banks lent less. What if the central banks do QE with pension fund instead? But the banks didn't lend less. They didn't have anyone to lend to. It's driven by the demographic. It says when that happens, the fund now owns less bonds, purple, but more deposits, red. Those deposits are not real economy money. The pensions fund can't directly spend them in activities boosting nominal growth, but it can use them to purchase other financial assets. Bank deposits held by non-banks, financial institutions, or financial sector money, not real economy money. In short, QE never prints real economy money, regardless of the recipient. QE only prints financial sector money equals bank reserves. The conclusions are all they told you about money printing is wrong. Our monetary system runs on two different forms of money, real economy and financial sector money. Government and banks print real economy money. Central banks print financial sector money. It says, if you enjoyed the thread, So what I'll say there is money has to get into the hands of people. It's got to be loaned into existence. That's your credit expansion. If that gets loaned into existence and something happens in the system where there's a deleveraging event, where it all kind of collapses, that's your collapse. It's that easy. Money that is created and goes into the banks from the Federal Reserve is not money circulating in the system. That's all he's saying. It doesn't circulate. It has to circulate in the system for that money to buy something. That's kind of your velocity, so to speak. So I agree with that, with the majority of what he said. Now, knowing what you know here, 15 visuals every investor should know. I'm going to tie this to what we just learned with real economy money. So when you get real economy money to come into the system, what happens is you get a shortage of goods and services. That is inflationary. That inflationary impulse pushes up interest rates, and money rotates differently. In these recovery time periods, they're all bull markets and commodities under slightly more, we'll say, inflationary periods where commodities had outperformed for the majority of these times in certain areas of these. So commodities did well in the 1910s. They did well in the 1930s, 40s. They did well in the 70s, and they did well in the 2000s. And I think what's coming is another time where Dow Jones is going to go sideways for probably 10 years or something like that. And then we'll see commodities outperform. And that deals with the real economy money. The real economy money comes from a demographic that has gotten larger in coming into home buying years, interacting with the real estate market and the banking system, creating loans in the system, great above and beyond the average. That happened here. It happened here to some degree. It happened in the 1920s. Then we had a big crash. And over here, they revalued gold. But it happened here as well and here as well. So this one here was a revaluation of gold. This one here and the destruction of credit in the 1920s and 30s. Here was that boom up phase in the 1910s and 20s. And then we had another boom phase here and boom phase here. Just wanted to tie that together. It says, what changed after COVID? What caused the economy to require 45% more apartment buildings? They're building apartment buildings because they can't afford to buy homes. It's based off the affordability. That's what I think. And then lastly, we've got even worse. US GDP is also being propped up by low energy return on investment, shale oil production that declines 45% per year. As the US shale industry runs out of high quality drilling locations, the real trouble begins. Two nails in the coffin: high debt and falling oil supply. Falling oil supply is your feedstock for gross domestic product. So if we were to look at, well, I won't go in there, but if we were to look at the M2 money supply versus GDP, you're going to see a dislocation between those two. M2 money supply goes up, GDP goes down, and there's your problem. And that's a big problem if you have high debt, because then you've got a bunch of money that needs to be created. You'll do deficit spending with high debt. Interest rates will go up because it's inflationary. And then you have a big problem because you don't have anything to grow your way out of it. The falling oil supply is the feedstock for growth. Energy is the number one commodity there. But that's what I've got for today, guys. Thanks for coming through, reading all this stuff with me. Give me a thumbs up for the content. Subscribe to the channel if you haven't. And if you guys want, check out the website, finding-value.com. Become a platinum member. Use the word discount in the coupon code. Get yourself a discount. And you can see a lot of information on there about learning about the cycles and all this stuff. I've got a lot of other information. And then you can also see my midweek updates and my weekend question and answer sessions for the platinum members. All right, guys, we'll catch you later. This is Finding Value.